Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. This video is part of my 5-part series where I explain the 5 key factors I use when analyzing companies. These are the pillars of my investing strategy. Today, we're looking at key factor 2, growth. A business can have high returns on capital today, but without earnings growth, it won't move the needle for long-term investors. Growth is what turns a good business into a compounding machine. And great investors all agree on this. Peter Lynch famously said, "The biggest winners are companies that can grow earnings for many years." Warren Buffett has often highlighted that growth only creates value if it's combined with strong returns on capital. And Charlie Munger summed it up best. The whole trick is getting more and more assets that produce more and more cash. So when I look at growth, I'm not just looking for any growth, I'm looking for profitable growth that can last. There are a few key metrics I focus on. The first one is the compounded annual growth rate for revenues. This shows how sales have grown over time. It tells me if demand is rising. Next up, net income CAGR. Profits matter more than just sales. A company can grow revenue but still destroy value if profits lag. And finally, earnings per share CAGR. This adjusts for share buybacks or dilution, showing how much profit per share is really growing. Together, these metrics show whether the company is just getting bigger or actually compounding value for shareholders. Let's take Meta as an example. Over the past decade, revenue has grown at an impressive 27.9% CAGR, showing just how much demand has scaled. Net income has compounded even faster at 36.9% CAGR, proving that Meta has been able to convert that growth into real profits. And earnings per share has grown at a remarkable 38.2% CAGR, helped both by profitability and consistent share repurchases. That earnings per share growth is especially powerful. It's what truly accrues to shareholders. Meta shows how explosive top-line expansion, when paired with rising margins and stock buybacks, can create outsized shareholder returns over time. Analyzing growth across decades and multiple metrics takes time. That's why I use Fiscal, which lets me quickly visualize revenues, net income, and earnings per share trends across companies. If you want to improve your investment research, check out Fiscal using my affiliate link below and you'll get 15% off at no extra cost to you. At EKH Capital, I focus on companies with a history and a runway of compounding growth. And as Buffett reminds us, growth without profitability is just an illusion. That's why in my framework, growth always comes after returns on capital. First, we make sure the company is efficient. Then we ask, can it scale profitably over decades? Growth matters because it shows the scalability of a business, drives compounding when paired with high returns, and rewards shareholders directly through rising earnings per share. The key is focusing on quality growth, not just growth for growth's sake. That's key factor 2 in my investing framework. Next time, we'll move to key factor 3, healthy financials, to see how a company's balance sheet can make or break its future. If you found this helpful, please hit like and subscribe, and let me know in the comments what's more important to you as an investor, growth or profitability. Thanks for watching, and I'll see you in the next one.